Can Taxes and Bonds Finance Government Spending? By Stephanie Bell. Section 4. Selling Bonds to Coordinate the Treasury's Operations. So far, we have addressed only the Treasury's attempts to balance its taxing and spending flows in order to minimize the reserve effect of its operations. Implicit in our discussion, therefore, was the notion that the government attempts to balance its budget. What if it doesn't? That is, what if the government runs a budget deficit? How does the sale of bonds affect the Treasury's cash flow operations and, subsequently, the reserve effect? There are three scenarios that must be analyzed in order to determine the reserve effect of selling bonds, the key being by whom and how are they purchased. First, it must be recognized that tax and loan accounts actually receive not only proceeds from tax payments, but also funds from the sale of government debt. When commercial banks with tax and loan accounts or customers of these banks purchase government bonds, there may be no immediate loss of reserves to the purchasing bank or the banking system. If, when the Treasury auctions new debt, it specifies that at least some portion of the bonds are eligible for purchase by credit to tax and loan accounts, special depositories may acquire the bonds by crediting deposits in the name of the U.S. Treasury. These depositories, therefore, will not lose reserves as they purchase newly issued bonds. Footnote number 14. The reader might wonder whether additional reserves are required as a result of the larger tax and loan balance. The answer is no. Since the establishment of interest-bearing note accounts in November 1978, special depositories have been free of reserve requirements against tax and loan deposits. Similarly, the purchase of newly issued government debt by a customer of a special depository, as long as the Treasury specifies that some or all of the offering is eligible for purchase by tax and loan credit, will leave reserves unaffected. For example, when a customer of a special depository purchases government securities, the Treasury redeposits the check into the bank on which the check was drawn. The bank then credits the Treasury's tax and loan account, offsetting the debt to the buyer's account. Thus, like the purchase of government debt by a special depository, the sale of government debt to a customer of one of these institutions can be effected without any loss of reserves. The second method concerns the private purchase of newly issued government debt that does not involve crediting a tax and loan account. When the securities are ineligible for purchase by tax and loan credit and/or are not purchased by a so-called note option bank or one of its customers, the purchase of government bonds will immediately drain reserves from both the bank and the banking system. This is because the proceeds from the sale of the securities will not stay in the system, but will be deposited directly into one of the Treasury's accounts at the Federal Reserve Bank. When bonds are sold in this way, member bank reserves decline as the Federal Reserve credits the Treasury's account, increasing the RHB in Figure 1. Thus, a bank wishing to purchase U.S. government securities when tax and loan credit is not an option will do so by drawing on its account at the Federal Reserve. A system-wide loss of reserves will, therefore, accompany every private purchase of newly issued government debt not eligible for payment through tax and loan credit. Finally, the sale of Treasury securities to the Federal Reserve must be considered. If the Fed purchases newly issued bonds directly from the Treasury, it will not cause a change in member bank reserves. This, as Figure 1 makes clear, is because both the RHB, U.S. Treasury balance at Fed, and the LHB, U.S. government securities, increase by the same amount, leaving total reserves unaffected. Furthermore, Since the government's balance sheet can be considered on a consolidated basis, given by the sum of the Treasury's and Federal Reserve's balance sheets with offsetting assets and liabilities simply canceling one another out. The sale of bonds by the Treasury to the Fed is simply an internal accounting operation, providing the government with a self-constructed, spendable balance. Although self-imposed, constraints may prevent the Treasury from creating all of its deposits in this way. There is no real limit on its ability to do so. Footnote 15. The Federal Reserve was, for a time, prohibited from purchasing bonds directly from the Treasury. This changed during World War II, when the Fed was authorized to purchase up to $5 billion of securities directly from the Treasury. Since then, the limit has been raised several times. Now, the Treasury clearly has choices regarding the manner in which newly issued bonds will be sold. For example, if the government plans to engage in deficit spending, the Treasury can sell bonds, allow them to be purchased by tax and loan credit, and thereby eliminate any immediate impact on reserves. Footnote 16. Bolding notes that deficit spending most commonly involves this practice. 1966. When the Treasury sells bonds in this way, the bonds act as a sort of ex-ante coordination tool. Since the Treasury can control the size and timing of funds transferred from tax and loan accounts, this type of bond sale helps the Treasury to drain more or less the same number of reserves from the system that are being added to the system as a result of its deficit spending. Footnote 17. Note that the government can deficit spend without taxing or selling bonds first, but that if government spending is greater than taxation, the banking system will be left with excess reserves. The Treasury, therefore, prefers to use bonds to coordinate its deficit spending, selling them to special depositories and allowing tax and loan credit before spending from its accounts at reserve banks. The bonds then allow the government to defend ex ante the Fed funds rate. If, however, there is a problem with the coordination, for example, if the Treasury and Fed underestimate the amount of checks that are drawn on the Treasury's account at the Fed, bonds could be sold in order to drain excess reserves. In other words, insufficient tax and loan calls, which result in a system-wide increase in reserves and threaten to send the overnight lending rate to a 0% bid, could prompt the sale of bonds as an ex post coordination tool. In order to immediately drain the excess reserves, banks could not be allowed to purchase the bonds by crediting a tax and loan account, but this is something the Treasury can specify, or something the Fed can do.